Thank you, everybody. This is Rob Barnes with Integrated Insurance Consulting. Today's subject is Life by Design. It is our last CFPCE presentation of the year, but it is our newest presentation. It's going to be the first in a potentially three-part series to help you better understand life insurance. And excuse me while I get us going. Okay. Today, today's a macro view of where we are and how we got here. I'm going to go through the evolution of life insurance. We'll look at a brief historical timeline and compare the past with where things are today. I will address how life insurance is priced and discuss the current options available along with how they work. And then finally, we will debunk a few of the most common misconceptions we see about life insurance. The evolution of life insurance takes us back to 700 BC when the first casket kitty was created. We forward to the late 1500s and find our first term contract was developed. And then it took another couple hundred years before life insurance reached the US with the Presbyterian ministers. And then 84 years later, what we now know as the real start of the life insurance industry occurred in the mid 1800s. Money, the Mutual Insurance Company of New York, is developed in 1843. And for those of you on the call today, Money is the remnants are AXA and the Equitable is the names that they work under today. After that, we find the Mass Mutual Life Insurance Company debuted in 1843. And 5 years later, the regulations started. We saw New York and Massachusetts both start insurance departments. So we're going to take a short visit along these historic moments. Now, the casket kitty, not to be confused with a kitty's casket, was started in the Roman days. And for any cat lovers on the call, don't fret. This kitty is on the casket, not in it. But when someone died, others would pitch in to help them provide a casket for burial. That's how it all started. Now, most insurance is a pooling of many to pay for the few. But with life insurance, that can be different because everybody dies. The life insurance conversation is different than any other insurance conversation because death is not an if, it's a when. We move along to 1583. On our timeline, we find the first term contract that we're aware of. William Gibbons was a salt merchant in London, and a consortium of 13 merchants headed by Richard Martin bought a one-year term contract on him because if he didn't make it back with their goods, they were out money they fronted. And that contract actually paid off 11 months into the 12-month contract. And so for 30 pounds, they received 400 pounds in the death benefit. And so at that time and along the way, annual renewable term was the most popular type of life insurance. And it's obvious that every year you get older, you're closer to dying, and therefore the costs go up this way. And that was what started the life insurance business originally. And so today, though, level term is what's purchased by most people. You have a rate lock. On the board is an example of a 20-year term. And what happens after the rate lock with term policies? Well, a few things can happen, but most of them drastically increase in price and go up every year after that. So after the rate lock, they are annual renewable term. But today, carriers are doing a lot to be the lowest price on the spreadsheet. And so they're changing things, making it harder for people to understand or look at the virtues and values of term insurance beyond price alone. So one thing they're doing is after the rate lock, instead of drastically increasing the premiums, they're drastically lowering the death benefit. And so that's an example of a 20-year level death benefit. And then it decreases substantially after that with the premium remaining somewhat level. Now, carriers are doing other things these days to be the cheapest on the spreadsheet. Some have gone a la carte. So where they used to include a conversion option for a period of time, or the full length of I should say the full length of the rate lock, they now only do it for a limited time along the way. So as an example, you might see a 20-year term with only 10 years to convert, but if you add the conversion extension rider, you'll have the full 20 years. And then other carriers are coming out with non-convertible options, again, looking to be the lowest price on the spreadsheet, because that's how a lot of people unfortunately shop for term insurance. And so what happens to your client if in the 19th year of a product like we're showing that is no longer convertible or never was convertible? What happens if they get a diagnosis that they're terminal and are going to be gone in a couple of years? You don't want that death benefit to drastically go down, but if you don't have conversion options, you might not have a choice. So moving forward on our timeline to 1759 in America, the Presbyterian ministers created the first life insurance company to protect their ministers' families. The Presbyterian Ministers Fund was created to provide relief of poor and distressed widows and children of Presbyterian ministers. Now, I've been around a long time in the industry, and this is actually a plaque that I've seen and live, but I've seen it in a number of old timers' offices, if you will, as I was growing up in the life insurance industry. So along the way in the mid 1800s comes the real stuff that we're aware of and have remnants still of today, because Mutual Life Insurance Company of New York, known as Money, they were created in 1843. Then Mass Mutual, who's still in operation and named the same today, in 1851, and 5 years later regulators came in. Now, in the 2000s, there was a trend to demutualize from a mutual carrier to a stock carrier. There were a number of reasons people were doing it, but access to capital was certainly one of them. And two of the biggest names that we know that demutualized back then were Prudential and Metropolitan. Now, Metropolitan has since busted up into a few companies, but the remnant of the individual side that carries individual life insurance is now known as Bright House. And I can tell you from my perspective, Prudential has fared a lot better along the way versus Met post demutualization. And so when you look at the fact that a life insurance company can be in business for three reasons: the policyholders, the stockholders, or even the management of the company. When you start thinking that life insurance is made up of interest, expenses, mortality, a mutual carrier only has to pay their stockholders, right? Assuming they're not greedy at the management level. And a stock company, though, has to feed their stockholders and do well for the policyholders. So I find myself these days using mutual carriers more often, especially for permanent insurance. And this doesn't mean a stock company can't be good, or that just because you're a mutual, you're superior. But if you're using whole life insurance, I certainly prefer to be with a participating policy, and you're likely to only find that with a strong mutual carrier. So we reviewed the graphs of a few different types of term policies. Now let's look at the permanent chassis that we have available today. By its very nature, the only policy that is scientifically designed to work properly with reserves held inside the policy is whole life insurance. You see, the mantra for whole life insurance is that the guaranteed cash value is going to equal the guaranteed death benefit at age 100 or beyond. Today, many policies go to age 120 now to endow, as we call it. And additionally, you'll find that the total cash value and the total death benefit equal each other at age 100 or 120 or somewhere in between. And that's due to adding the dividend cash value and the paid up additions if they use that to grow the death benefit. But this is the axiom. This is how life insurance for whole life works. And when you're using expenses, interest, and mortality assumptions, you back into whole life, and there's only one premium that you come come up with, assuming you're not blending. That's a subject for another day. But if you have an all-base whole life contract, there's only one premium. And if you're paying that through the years, you're going to see the policy endow both on the guaranteed side and the total cash and total death benefit each equal each other somewhere down the road. We'll be sharing the axioms of the different chassis as well. So back to our timeline. For over 100 years, we only had term and whole life insurance, but in the late 70s and early 80s, new types of life insurance were created. These new products were made with both temporary and permanent design features. And in 1979, E.F. Hutton spoke and introduced universal life to the world. And just 7 years later, the Equitable issued the first variable life contract in 1986, and it took 11 more years before Transamerica invented indexed universal life. And then finally, it was the late 90s when guaranteed universal life was introduced in the world. I think it was AIG, and for sidebar, AIG is now rebranded under Corebridge. So let's look at a universal life structure and how these work. You see in 79, interest rates were at double digits, and universal life was able to adjust their crediting rates faster than whole life policies. And if you were earning a lot of interest, you could pay a much lower premium than whole life because your cash value was working harder for you, so to speak. Some people were borrowing from or cashing out of their whole life policies to invest in a CD or this new type of interest sensitive life insurance. But what goes up comes down, and for several decades, we've seen falling interest rates until the last few years. So universal life of any type needs to be monitored and adjusted along the way. Many of these older policies are grossly underfunded and may not last as long as a client does. So the mantra that a universal life policy works on is that as long as there's money in the bucket to pay the insurance charges, we're okay. But these insurance charges, as we look just like, because they are, annual renewable term. But there's two sets of these numbers. When you look at illustrations, there's a current mortality cost and there's the guaranteed maximum that they can increase to. You see, the concept of a universal life policy is that you're going to pick the premium that you want to fund with. So in our example here, premium 2 is the right funding, supposedly. So we're overfunding well above the insurance charges early on, and later when those insurance charges cross over to be larger than the premium, we start now eating into cash value, or so that's the theory. So what you earn on the policy cash value is your performance risk and rewards. What they take in insurance charges is the mortality risk, and you only control, as a policy owner, you only control the premium payment risk, just like with any other life insurance product. But you can reduce or eliminate this risk by funding policies over a shorter period of time. We'll discuss this a little bit more. So back into our timeline here in the mid-80s when Equitable developed variable universal life. We now had the availability to show 12% rates on illustrations. And since we were still in a long bull market, no one expected it to end. But just 1 year later in 87, we saw a market crash. And that certainly repelled people away from some of the variable life policies available at that time. And where you once had a very safe and reliable policy with a whole life chassis, now you could even lose cash value in a down market. And too many people were relying on market returns to sustain the policy. And that's where things started to get in trouble with these. So one of the best ways to utilize variable life as an investment alternative is to max fund it. And I'll discuss this a little bit more as we go on with the presentation. Just a pause for those who came in late. We need everybody to stay on and log in 50 minutes. And you have a questions box if you want to ask questions along the way, and we'll get to them at the end of the presentation. So one of the best, excuse me, I already said that. So moving along our timeline to 1997, Transamerica introduced universal life. It was the best of both worlds for some. There were no losses and the upside potential of the market returns. And today, this is the product being pushed by many carriers, and it's still misunderstood by many advisors and agents that look at them. So the life insurance illustration, it's not about a pretty illustration. In fact, I'm very good at looking past the delusion of some illustrations that are put out there. But specifically, when we look at the different permanent chassis out there, whole life and universal life will compound because they're only going to earn interest or have increase in guaranteed cash value and some dividends. But when you look at an indexed universal or a variable universal illustration, they don't compound. So even if we're showing a 6% return, the only thing I know is you're not going to earn 6% each and every year. With an index product, you're going to have some years where you earn less than 6 or even 0 because the market's down and your indices are down. And with variable, of course, you could lose money, let alone, but you can also earn more. And so, what I look at and what I've learned to look at ledgers is when if you wanted to show, first of all, I should back up that few people are showing 12% anymore on a variable life insurance illustration. There are some limitations to what carriers can project on an indexed universal product, but they've gotten creative again on how they can have a prettier illustration. So we have to look through that at reality. And so if you're showing 8% on a variable life, I prefer to show 6 because you might average 8. I won't argue that, but averaging 8 is closer to looking at compounding at 6. I find a 2-point differential there. And so it just makes sense to look at these illustrations that are projected in several ways. So the next product on our evolution comes in the late 1990s, and we have guaranteed universal life. People already saw the risk of the money running out of the bucket and you losing your insurance coverage, and so they wanted to do something to shore that up. And so the mantra, the formula that drives guaranteed universal life has nothing to do with cash value or even having money in the bucket. It's a formula driven by, again, interest expenses and mortality and the timely receipt of your premiums. And so as long as you pay your premiums in a timely manner, you'll have a death benefit. Now, if you've never seen a guaranteed universal life illustration, it's very clear that you have a product that is secondarily guaranteed. If you're looking at the guaranteed columns and you see cash value go to 0, but you still see a death benefit, that is what a guaranteed universal life illustration would look like. And so we can design these products to be there as long or as short as you want. And so some wording that was coined to me actually by a client that I was showing this kind of product to many years ago. He coined the phrase of permanent term, and I've used it ever since. So we can design with guaranteed universal life term to age X or year Y. So again, mortality doesn't matter in these because it's not working off money in the bucket. It's working on the formula of timely receipt of your premiums. So unlike a regular flexible universal life where you have differences of premiums and stuff, if we're designing a product to be guaranteed age 100, it's going to come out to one premium. And as long as you pay that in a timely fashion, you'll be okay. But if you start skipping premiums, pay them late and so forth, and in some cases, this goes against the logic and reason here, but in some cases, if you pay premiums early in a guaranteed universal life, you can upset your secondary guarantee and actually shorten it. But the good thing is, if you get off track in these products, you would be able to get back on track with catch-up premiums to reinstill the guarantees. And so if we were looking at the cash value on the current side of the ledger in a guaranteed UL policy, it would look like a hill. In other words, the cash would grow and it would reach the pinnacle of the hill, and then it'll start to dissipate and disappear. Long story short, it's just a different design where whole life guarantees not only the death benefit and the premium and the cash and so forth. It has to grow cash. It's a linear diagonal line as we looked at a few minutes ago. But with guaranteed universal life, they're priced so that they can't let you have your ball and bat and quit the game and take that with you. So that's why by mortality age for most people, you'll see indexed universal life with falling or maybe no cash value left in the policy. If you want guarantees and guaranteed cash value, that's the whole life chassis. So there's three risks to a policy that any client faces. They have payment risk, they have performance risk, and they have mortality risk. Okay. So payment risk is an exposure you have for all policies, but there's ways to minimize or eliminate it. You could make a single premium policy. You can have your policy premiums withdrawn from your checking for discipline. And as long as you have money in the checking account all the time, you won't have trouble forgetting to pay your policy in a timely fashion. But performance risk is nothing a client can control other than choosing the risk level they care to have, which is the design on the front end, right? These can go from no risk to full market risk with utilization of variable life. More mortality risk can be eliminated with a guaranteed UL structure or whole life, or mortality risk can be minimized by using more conservative design assumptions and or heavier funding of the policy premiums. So what do we do to design a policy? These are the questions that we ask. So life insurance agents, when I was a young buck at Prudential, life insurance agents used to be known as field underwriters. In fact, I carry the CLU designation, which stands for Chartered Life Underwriter. I continue to be a field underwriter, and I'm practically part doctor from all the things I've learned through the years about health and how it affects the mortality and the pricing of life insurance. But we believe that managing expectations with your clients is vital. And so it starts with knowing their health. It takes money and good health to buy life insurance. Our screening allows us to quote accurate and expected pricing, and it also helps with the carrier selection. Underwriting is not equal, and this is why we work with many carriers to better serve your clients. So, are we looking at a temporary or a permanent need here? A good way to understand some of the core differences between term and permanent insurance is to think about renting or owning a home. If you rent, you might want to include an option to buy, and that's what a conversion option on term insurance is meant to be. It's important to consider. It provides flexibility and options down the line. You won't corner your clients if things change, didn't work out the way you thought. Many clients buying term today are unknowingly being sentenced to term for life. When designing permanent insurance, it helps to use some car analogies. We start with the chassis of the car that we want, and then we consider the engine. Now, not all combinations are available, and specifically today, whole life only comes with the bank engine and dividends from participating carrier. So the first question when designing permanent insurance is to confirm if you want projections or guarantees. If you're projecting insurance, you can have a universal life, a variable universal life, an indexed universal life. And if you want guarantees, term is guaranteed, but for a limited period of time. Whole life is guaranteed, if it's all base, of course. And then you can put a G for guaranteed in front of any of these chassis. You can have a guaranteed universal life, a guaranteed variable universal life, or a guaranteed indexed universal life. And so these will change the money in the bucket to the formula approach. And again, if you timely pay your policies, you'll take some of the risk or all of the risk away, depending on how things were designed. So what engine, or excuse me, what chassis do you want to start with? Whole life is the most durable. So we're showing you a Hummer here that can get through any terrain, and the terrain would be a bad economy, interest rates going around, the market's up and down. It doesn't matter. Whole life's going to go north every year, no matter what's going on around it. For universal or index universal life, some people are just looking to have insurance for the long haul, a nice steady ride, and they'll ride some of the ups and downs of things along the way. And of course, variable life is the sports car that can get you to where the UL, IUL would go, but faster and assumptively faster than whole life as well. So it'll likely depend on what the goals and expectations of the situation are to know which tool is the right one for the job. There is no one size fits all in life insurance. And just as you might diversify your portfolio of investments, you may care to have a couple types of policies to better accomplish the goals. This could be some term and some permanent. This could be several different permanent policies because we want more flexibility, or we're designing one to be protection only and we're designing the other one for accumulation. So that would be a reason to have differing policies. Once we know the chassis we want, then it looks at the engine. So life insurance is all math. It's based on the three variables of interest, expenses, and mortality. You can choose the interest or earnings option you care to have. The fixed interest is a declared rate each year, much like a one-year CD at the bank. Index options, you're not in the market, but you're credited interest based upon the performance of the market indices that you choose. There's upside potential with limited or no downside risk. And again, I want to emphasize in my world, all the things that I get to see, I don't expect more than a couple more points for an index product above a fixed product in the long haul. There have certainly been periods of time when one has shined substantially over the other one. And that's the point. The economy and the market and all that changes down the road. And so some people just want reliability in their insurance and the safety net that it is. And if we're looking to go full on investment oriented, then you can choose variable life insurance with sub accounts that are very similar to mutual fund investing. It helps to know the purpose of the policy it helps to know the purpose the policy is being purchased for. Are you looking to protect, accumulate, or are we trying to do some of both? The answer to this will narrow down our options or may point directly to the right chassis and engine that we should have. Stephen Covey in his Seven Habits book teaches us to begin with the end in mind. And this is vital for life insurance design. Design problems can occur if you choose the wrong tool for the job. And of course, projections are not guarantees. If you're overly aggressive in your design projections, you may be disappointed later or find yourself heavily funding policies. So a new question you may care to ask your clients is, do you want any coverage to be there when you die, no matter the age? Now, this is not really a question to talk about term versus perm. It's a question I use when educating your clients about the term options available. If they say no, then they can buy any term product regardless of its future flexibility, limitations, or conversion options that it has in it. If they say yes, then quality term should be considered. Or maybe if they're saying yes, maybe some perm is there now. Again, diversifying. I want some till the day I die, but I need this while I'm young and making big coin. If they say maybe or I don't know, then we might want to mix in some quality term with the rest of the term, not buy everything via the cheapest price, but have something that gives us flexibility for the future. So I'm going to pause a second. Again, if you came in late, you have a questions box that you can ask questions on along the way. We will be delivering a recording of this presentation along with a kit of information. We'll show you a few of those pieces in the next section here. And thank you for taking time to learn with us today. So I'd like to review some of the misconceptions and add some insights about life insurance. Now, I don't know about you, but the longer I'm away from formal school, I find myself going to the dictionary more and more to find out what words mean. Am I using them in the right vein? And of course, we don't have to use a dictionary nowadays. We just have Google. So my Google definitions for misconception are a wrong or incorrect understanding or interpretation. And the definition per Google for an insight is the power or act of seeing into or understanding a situation. Now, I find these top reasons for misconception to apply to life insurance as well. So, one example of a cognitive bias is some people think you should never buy whole life insurance. Find a lot of people these days suffer from limited information. There's just so much to know as an advisor, and you can't be great at everything. And that's why IIC is dedicated to partnering with advisors to help them serve their client protection needs. Doesn't matter if you're licensed or not, or who's doing all the work. We're set up to help you, and we're on staff at an insurance brokerage operation, which adds power to the situation as well. The fact that life insurance pays a commission is upsetting to some people. That alone is not a reason to buy or not buy life insurance. I'll tell you, the hard reality of today is there's very few viable commission-free life insurance options available. I assure you, I continue to monitor the marketplace, and two things have happened in the last 5 years that tell me it's going to be a long time before we have a vibrant commission-free marketplace. TIAA used to offer commission-free term and other types of life insurance, and they pulled out of the market. And then Haven Life, a wholly owned subsidiary of the Mass Mutual, they were a direct-to-consumer, no commission, no agent involved, and they just closed their doors earlier this year. So it tells me we tried, but we couldn't do it. So one exception, though, in this marketplace is the variable life arena. Some noted carriers have developed a fee-only RIA platform allowing you to implement variable life for your clients without having to be insurance licensed. So if it helps at all, I like to think of the commission as my payment for implementing the protection part of the plan. As we know, no matter how good a plan is, it only works if it's properly executed. I get paid when they get protected. So there's certainly some bad apples in my business that intentionally manipulate the wrong message to people, but the answer is not never permanent, just like it is not always permanent. And in the term versus perm or how much, whatever, the amount of coverage trumps all other things. So that's where we get the budgets and limitations and such. Hey, we'd love to have 2 million of coverage, but we can't afford it for 30 years or forever. So we'll take a 20 year or a 10 year because we need to worry about today the most. So never buy whole life is one of the misconceptions I just mentioned a few minutes ago. I have to clarify with people when this is brought up to me, whether it be a client or an advisor. Do you mean whole life or do you mean permanent? You see, a lot of people misconstrue and use the word whole life when they mean permanent. So permanent coverage encompasses whole life and universal and indexed and variable and guaranteed universal. All of those are flavors of permanent insurance. Whole life is just one that differs from all the rest. And I also want to know, who's told you this? Why do you believe it? Where are you coming from? I need to understand what you know, what you think about it. And I'm not here to brainwash anybody, but I want to make sure that people have the right information. So you'll see educate is part of our mantra in working with you today with these programs, along with helping your clients. So an educated consumer is our best customer, as old Cy Sims used to say. So in the investment world, you can consider a whole life policy as a bond alternative. It's an uncorrelated asset class and it only goes up each year premiums are paid. It goes up each year by design. It goes up irrespective of the market or interest rates or the economy. And one children's story parable that I'll bring into the world here is, you remember the story about the tortoise and the hare? Well, whole life is the tortoise here. Okay, so onwards with our insight over risk management versus investment. You see, I personally think one of the worst things we've done in the life insurance industry is try to compete with investing. I believe we can, make no doubt about it, and we can outproduce it in some ways, which I'll share, but um, it's about having the death benefit. And the death benefit today is much more valuable than life insurance in the past, because now a lot of carriers allow you to add a long-term care rider to your life insurance policy. And I'll say it now that I think the future of long-term care planning is life insurance, permanent life insurance with a long-term care rider. But we're going to send you this white paper from Wade Pfau as part of the kit, and he discusses how integrating whole life insurance into retirement income planning can help it. Today, the biggest fear most people have is running out of money. And so one of Wade's points is that a strong cash value in the policy can help as a longevity income safety net later. You can take out tax-free money from the policy, or you can annuitize the cash in the policy and have a partially tax-advantaged income for the rest of your life. Another way to look at it is by owning the life insurance policy, it provides you a permission slip to annuitize other assets if you're worried about running out of money and the pile's going down. Having the death benefit paid up allows you to annuitize other assets while not disinheriting your heirs. And so, since long-term care is a major event that could cause you to more rapidly run out of money, we certainly think that I offer it to most people buying permanent life insurance these days is, do you want the chronic illness or long-term care rider to it? Because that makes it a much more comprehensive risk management tool when you add the rider. Again, this conversation of life insurance is a risk management conversation, not an investment. I know you might out invest my life insurance, but I also know you might not. You're missing a lot of variables, and only hindsight's going to tell you if you will. So with that, we move on to misconception number 2. I remember when A.L. Williams, that's how long I'm in the business, started preaching this mantra, and now A.L. Williams is known as Primerica, and they still preach buy term and invest the difference. I understand the argument, but I disagree with it because of discipline and tax advantages of the life insurance wrapper. You see, the bottom line with investing versus life insurance is you may or may not out-invest it. You're missing some key variables. And as mentioned, only hindsight will tell you, but most people aren't disciplined enough to start that side fund that's going to ultimately be their permanent safety valve, if you will. So it rarely works and certainly not guaranteed, but if out investing life insurance shouldn't be the driving decision to own coverage or not, it's really a risk management tool and a safety net for people. Insight number 2, though, if you are looking to use life insurance as an investment, then there's certain things that you can do to make it better. So life insurance has tax deferred benefit capability, as long as you don't make it a MEC. A MEC is a modified endowment contract. And I was actually around, again, that's how long we're here. I was around when the MEC laws came out. You see, we used to take $99,000 and dump it into a $100,000 life insurance policy. Our net amount at risk was only $1,000, and there wasn't a lot of charges to cover $1,000 of protection. So essentially, you had a tax-deferred ball of money growing, allowing you tax-free access to the money if you want to during life. And when you died, it paid out income tax-free as well and stepped up to the death benefit level. But the MEC rules have limited how much we can put into the policy. There has to be enough separation between the death benefit and the cash value called the corridor of insurance. And so you might not be able to put $99,000 into a policy, but you can still heavily fund these policies and have them grow. So a heavily funded universal life policy of any engine performance has less risk of being in trouble later. The ultimate strategy is the insurance costs are far outweighed by the tax savings. Think of it as a Roth alternative for those of you without any income restrictions. So, what do you do if you have your high income earning clients that are looking for other tax advantage places to save, already max funding their 401ks and such? If they're using term insurance, maybe you want to look at the concept of heavily funding life insurance. So, think about it this way. If your client has a non-qualified investment and they have the Star Mutual Fund that's been stellar for years, but that Star manager leaves, now you want to switch to a different mutual fund. Well, if it's in a non-qualified account, you're going to have to pay some tax in that transition, probably. If it was inside the wrapper of variable universal life, you wouldn't. And so, again, the years and years of very small insurance charges compensates for the tax advantages and the ability to switch funds and such as well. So, move on here, excuse me. I follow a few industry news sources, and every once in a while I find something I need to opine on. I just can't keep it in. Recently, a thread was going around with many advisors adding their thoughts and insight. The essence of the situation was a husband just died, and the wife found out she's going to get less Social Security, and he only chose a 50% joint survivor on his pension. I realize fewer have pensions, but there's still some that do. And so, the other thing that happened was he was sick before he died, and they used a considerable amount of the pile of money for his care that she was no longer able to provide. So in my world, this is known as the triple widow whammy. She has less assets, less income from two sources, and she's going to live a lot longer perhaps. And so they bantered back and forth about the situation, talking about annuitizing this, doing that. And I just simply asked one question. How would things be different if he had some life insurance in force when he died? You see, that article that's on the board here, this is something you can find for NAPA members. It's an article I wrote for the magazine a while back, but your life insurance policy doesn't have to retire when you do. This is getting to the words of need versus value. Somewhere along the line, did somebody tell that guy that he didn't need life insurance? Did they fail to explain to him the value of life insurance, that this will help offset those losses for your wife, assuming you die first? Had he had a long-term care rider on it, maybe he would have taken care of that and she'd still have more in her pile of money to live off of. But I don't think, from my experience, I don't think that all needs disappear. I think they do dissipate, but more likely they change. So what I need when I'm younger as an income replacement might still be income replacement for my spouse if I die first, right? Adding the rider changes everything in a value proposition of what permanent life insurance can add value to for clients. And so value and perspective of the asset can change over time. And I assure you, I have stories. People who wish they would have taken different advice or done different things now that they're in the hole that they're in, and life insurance could have helped out. So a lot of people are going around saying you don't or you won't need it, right? You don't need it after the kids are grown up. You don't need it after the house is paid off. You don't need it after you retire, but will you value it? So a recent study was issued by Ernst& Young. We'll be providing this in your kit too. And essentially they say some permanent life insurance in the plan can enhance many client outcomes. And life insurance can replace lost Social Security. It provides liquidity in a time of need. This keeps them from liquidating the wrong asset at the wrong time. You know, if you have to pull into your qualified plan to take money out for long-term care, you got to take the taxes out too. And if you're in the stock market and the market's down, then you're going to realize losses by doing that. So having a tax-free asset, a bucket of your assets that you can access for different things, can add flexibility and more and assure a more positive outcome for people is the bottom line. I understand your clients have other assets, but do you know what the cost of liquidity will be? If you have tax-free access, you don't have to worry about the cost of liquidity. And so our last conception here is people more and more are shopping on price alone for their insurance, and it's a mistake that many are making these days. They're certainly easier to acquire life insurance. A lot of people are selling it. You can buy it online from 800 numbers and so forth, but few and fewer are helping educate your clients to buy the right kind of term for their situation. We adhere to our process, and our step number one is to screen their health. We then educate and design what they want. And again, this question helps us know what term your client should have today. Do you want any coverage in force when you die, no matter the age? Simply a quick way to get them to think about the term they're buying today, and that, 20, 30, 40 years out, things can change, right? Stuff happens. And if they say yes or maybe or not sure, maybe we want to mix some quality term just in case they decide or need to have it longer than they first thought. If they say no, we can buy the lowest price policy around. So when we excuse me, it's been stated that you never have to apologize for quality. And so it is with term insurance. Time has a way of changing things, and things don't always work as we planned. And quality term offers a plan B. It locks in a client's good health and allows them to carry coverage longer if they later choose to. Think of it again as rent to own or a call option to get something at a specific price down the line. That's what quality term can offer. So when we work with your clients, we send a spreadsheet of all the carriers we have on this one spreadsheet stuff. It's a lot. And we pull off of them and we identify somebody for strictly term. We don't call it the cheapest term. We identify somebody for quality term, and we also identify something for term with more. And I want to spend a second. So I was recently at the Nashville conference for NAPFA, and I was in a long-term care class. Somebody else was teaching, and somebody in the audience asked, well, what do we do for our younger clients? How do we get them long-term care, or how do we lock in their health? And this wasn't mentioned, but I'm mentioning it to you now. So there's one carrier that has a special rider that you can add to their term policy. It's a quality term, and you can add this rider. And so if a policy is convertible, they can work different ways of what they offer you to convert, but they'll only convert the death benefit. They won't let you add a long-term care rider on the permanent policy, even if they have one. And so how do I guarantee that right to not only convert to permanent, but add the long-term care rider? Well, with one company, you can. And so I'll tell you the Mary story very quickly. Mary's 40 years old. She buys a 20-year term. And 5 years later, the what if turns into what now for Mary, because she's in a car crash and she's paralyzed from the neck down. No doubt she needs care. If she had this product with this special rider, she would convert her term to permanent, and 90-day waiting period later, she'd start getting 2% of the death benefit paid out until the entire death benefit was paid to her for care. Now, you and I know that's a rare occurrence when that's going to happen. What's more likely to happen for Mary is 18 years down the road, she's now 58 years old. She's getting in a home stretch of retirement. She decides to start looking into long-term care, but she finds out, because she was recently diagnosed with MS, that she's not going to qualify for most long-term care products out there. Again, had she had this product with this special rider, she could convert and have the Life with Rider version of long-term care coverage. So there's value, and go one step further. If neither of those things happen, if Mary's totally healthy 20 years out, then we could look back with hindsight and say, you paid a little bit more for your term than you should have or could have. But we don't know that from today looking forward. And again, that's what risk management is about. That's what having a safety net underneath you is about. So an important term policy, something to be aware of. And then in closing, please do ask any questions. We'll get to them in a minute. but I have just a couple more slides. So if you're new to us today, this is the first time you're seeing us present. I don't want all this permanent talk to dissuade you or concern you. So I want to show you our process. We've only worked through advisors and their clients for the last 25 years. And we know that if you give us a job to do, my client needs a 20-year term, we're going to implement that coverage for him or her. We are certainly going to educate them on the different flavors of term, and they can buy whatever it is that they want to buy. So I don't want to think that we're shifting. In fact, if they tell me they want some permanent, I'm coming right back to you to say, hey, wait a second, they shifted the game. But we're also here because there's so much to know as advisors. We're fully capable of engaging with you to discuss a client fact pattern and come up with some solutions, or we can do it directly with the client, with or without you there. It's up to you. So we want them to have what they want to have, and we're not here with our own agenda. If they want X, Y, or Z, that's what they're going to get. And so rest of our process, we're certainly going to get to application underwriting, and then we do deliver a kit of information back to you and your client, and letting you know everything's good. And then we do have a client process. We do a lot of things with your client, but the one thing we're not going to do is start quoting life insurance when we know nothing about their health. And that's why step number one is to pre-screen. We then educate and design what it is they want. We want them to have the right fit, and get to application, underwriting, policy delivery, and placement and such. So onwards, if I may, in closing. So one of the reasons I love life insurance is because it really is the Swiss Army knife of financial tools. It's simply a tax advantage tool. It's a leverage tool. It's a liquidity tool. And the beauty of life insurance is in the eye of the beholder. I'm not here to twist anybody's thinking. Maybe I'll stretch it or add a different perspective you hadn't thought of. But what I see today is a lot of people are skipping by the norms of financial foundations that we grew up on, and you have to protect first and then you accumulate. How many people I find with insufficient insurances in the life or disability, or older people where they were never mentioned to look at long-term care and so forth. And anyway, we work with those products along with fixed annuities. The life insurance is not only the financial foundation of planning, it adds flexibility and confidence to the plan. And if there's nothing that you've learned today, I hope that you've seen that the life insurance conversation is different than any other insurance conversation, because in life, death is the only for sure. So I appreciate you paying attention. I'll put a picture of my mug on there. And if there are questions, I'm going to start looking at them here. Bear with me. I have to find them first. Here we go. Okay. Okay, so thank you, anonymous attendee. IUL gets a bad rap due to high costs and commissions. Can you speak to that? In what situation is IUL the right choice amongst the permanent insurance options? Well, I'm going to ask the second part of that first. IUL is when I want a lot of premium flexibility and I don't want to be in the market. I don't want to lose money, and want to be kind of safe on my cash growth. That's when I would be looking at an IUL. In regards to the high costs and commissions, again, there's ways to minimize and eliminate those. Maybe along the way, stuff will come in the indexed arena. There might be a product or two out there that doesn't have a commission, but please don't confuse the fact whether or not a policy has a commission as to it's better because it doesn't. I can certainly show you right now. In fact, some of these RIA platform variable lives, I outperform with my off-the-shelf stuff, and I have commissions in there, and it's a matter of what load you're loading in for your trail and your service fee, if you will. So IUL has a place. Again, you start back at, do I want guarantees or projections? If I want projections and I want to be safer, then you might be looking at IUL as well. So thank you for your question. So through the lens of bond alternative, does whole life outperform the CPI inflation? So what I will tell you about whole life insurance that I find is that it in the long run is going to perform between 4 and 5% on the cash value and maybe a little bit higher on the death benefit. So if that's beating the long CPI, which I believe is more 3, then the answer would be yes to your question there. So it can. And again, what's going on in my with a lot of overzealous agents is they're showing these IUL illustrations to clients that wow them and aren't going to come true because of the way you need baking time with permanent life insurance. So you need the insurance costs to be offset by the performance and non-taxation and stuff over time. And to the first question, one of the ways I reduce costs and commissions is to heavily fund the policy so that there's a smaller array between the risk and the cash value. So just to, if you came on time, you're welcome to listen to all of our questions. I am recording this till the round out hour, so you can listen to these later. And if we don't get to some of these, I will answer them individually to you. But thank you for attending. Wishing you a Merry Christmas and a great New Year. And look for us next year. But I'm going to continue on answering questions for everybody. So thank you for your time today and learning. And please circle back to us if we can be of service. So next question. How will policies succeed or fail in a multi-decade rising rate environment? This is a great question, thank you, because we've seen it, and if you look at the history, universal life came out when we had double-digit interest rates. And then it disappointed us because we built it and designed it to have those double-digit interest rates in the engine, and it didn't come true. And so I've seen through my career a lot of underperforming policies, especially in the universal life and even variable universal life things. So, and likewise, so when I started the story in the late 70s, you had people borrowing from whole life to put it into a CD at the bank because the CD was making double digits and their whole life wasn't. But go back 5 years or until the last couple of years when interest rates rose. If you look at the decade we had with very low rates, whole life looked great. So I swear I should get some trail commissions from some of these policies that I re-explain to people how good they are that you've had them baking all these years. And again, the successes I've seen the most are participating whole life with strong carriers. So why can IUL be sold without a securities license as VUL? Because you are not in the investments themselves. You are in the company's general account, which is backed by the long bond. If you want to break it out in a universal life contract, right? I take the premium as the company. I invest some of it in the long bond and a little bit in other things to increase my yield. Let's say I'm earning 5 and I pay you 4, right? That's what goes on in a universal life. In an indexed universal life, I don't pay you the 4. I take the 4 that you would have earned and I hedge the market indices with options to be able to pay you a higher rate. Now, the caps and limitations on index products are a direct derivative of the cost of hedging the plan. So I'm still in the company's general account, and instead of paying you that interest like a UL would, I use it for hedging. So that's a good question, and hopefully that makes sense for you. So we are getting to the end of the hour. Appreciate everybody staying on. And if you have other questions, confusions, we can look at existing coverage for your clients or proposed coverage for your clients and give insight to those situations. And thank you again for taking time to learn with us today.